So let's talk tariffs. So tariffs are taxes on imported goods, and Trump is proposing a universal baseline tariff of 10% of all goods imported into the United States.
Now, if you recall from Trump's last presidency, tariffs were market movers. Whenever he came out talking about putting more tariffs on China, you would see the stock market move in various directions. Now, when it comes to tariffs, there are winners and losers in the US economy. Now, because tariffs are used to encourage US companies to bring manufacturing back to the US, companies that have a substantial amount of manufacturing outside of the US, these are the companies that will be hurt most by tariffs. So you see, Trump's goal with tariffs is to protect domestic industries, create jobs, and reduce a reliance on foreign manufacturers, particularly from nations like China. Now, Trump has argued that higher costs on imports would incentivize businesses to produce domestically, thereby boosting the American economy. But for our investors, let's talk about the stock market implication of tariffs. So companies dependent on international trade, for example, tech companies that rely on folks like China for their manufacturing components, might see higher cost and compressed margins, potentially driving the stock price down. You will see this on their earnings call when they talk about their increased costs due to tariffs. These tariffs are going to reduce their profitability. And the stock market is not going to reward companies like this that depend so much on foreign manufacturing. You may see these companies' stock prices start to dip when Trump starts to introduce new tariffs.
Now, on the flip side, for domestic focused industries, these companies may actually gain a competitive edge over those companies that are really relying on manufacturing outside of the United States.